So in this video we're going to take a look at what I call the organised pawnbroking market. Estimated to be worth between 5 and 10 trillion US dollars. It's another one of these markets that's hidden to the average investor, but was largely responsible for the downfall of MF Global. It also contributed to the downfall of Lehman Brothers and Bear Stearns. So what is it? Why is it important? And why should investors worry about it? Well, first of all, the name. It's called the repo market. Repo market. And a repo is a very simple pawnbroking style transaction used in financial markets. All right, so I'm going to introduce my malnourished looking traders, all right, to just illustrate what a basic repo would involve. So imagine you have trader A and trader B. All right, now basically if I was going to try and raise money short term, what I might do is go to a pawnbroker, hand over my watch and say I need to borrow 100 quid. All right, the pawnbroker looks at my watch, thinks that will do as collateral. Okay, Tim, you can have your £100, but number one, if you want your watch back, I need the £100 back plus interest, and maybe number two, I need that to happen by a certain time. All right, it's not just an open-ended transaction. Well, that's how repos work, except that we're not talking about me and a pawnbroker, we're talking about market participants, okay, financial institutions, and we're not talking about using our watch as security for a loan, we're talking about using something like highly rated bonds instead. So we're using securities as the collateral for a loan, short term, rather than something like a watch. But the principle is very similar. So imagine my guy on the right here, okay, needs to borrow cash. Could be sterling, could be dollars, could be euro. Okay, in the repo market, what you can do is say, well, I need to borrow cash. What I'm willing to do is post securities as what we call collateral security. All right, and the deal is that at some point I will reverse this transaction. It's talking about this fella here. So in other words, this fella here is saying, well, by a certain date, I commit to repay the loan, at which point I'll get back my securities. All right. Now, this isn't free. You can't borrow money for nothing. So, having said this is a repo transaction, a sale and repurchase agreement, the repurchase, if you like, is the bit where basically this guy here returns the cash plus a bit of interest called the repo rate, all right, and gets securities back in return. Okay, and over here, all right, you'll have this chap over here saying, well, basically, am I satisfied that these securities represent security for the amount of cash I'm lending, all right, and they might impose what's called a haircut. Okay, they might say, well, actually, you need to post a little bit more than the value of the loan in securities terms, because if these securities fall in value, I'm exposed at the other end of this trade. All right, so there's some basic jargon. You've got a repo, all right, which is basically, as I've described it, a loan collateralized by hopefully high-grade securities like government bonds, for example. And the advantage of using high-grade securities is that the haircut applied by the lender is relatively small. Okay, they're going to say, well, these are good quality securities, so basically I don't need you to provide many more in value terms than the actual loan itself. Right? And there's your basic repo. Okay, one or two little twists then. So we've done the basic jargon, one or two twists. Okay, is it always true that the motivation behind a repo is this chap here needs cash and is posting securities as collateral? No. Okay, how about this for a thought? Could it be that this chap here needs a particular security that this chap's got, okay, and wants to borrow it short term and is willing to post cash as collateral? Get the idea? A slightly different motive, right? So this chap's thinking, I've got the security you need, okay, I'm prepared to lend you the security, all right? What happens in that case is that looks very similar. All right, the initial exchange is cash this way. A particular security needed perhaps to close out a position over here is lent. All right, and then the reverse of the transaction involves slightly less cash going back, because in that instance, this guy has provided this guy with a loan of securities. So repos, the motivation, all right, can work two ways. It can be someone saying, I need cash, I want to use securities as collateral, or it can be someone saying, actually, I need that security that over there for a short period, maybe to satisfy some sort of short selling obligation. See my video on that if you're not sure what I mean there. Okay, and I'm willing to post cash as collateral, okay, in order to get it. Now, this all sounds pretty innocent. So far you're thinking, well, it's just pawnbroking with a posh name involving government bonds as collateral, for example. So what? How can this cause trouble? Well, it can cause a lot of trouble. Let me give you a couple of examples. Okay, number one, Lehman Brothers. Lehman Brothers was famous just before it went under for the so-called Repo or 105 transaction. All right, now, don't worry if you don't fully grasp the accounting I'm about to mention here. It's not a big problem, but the underlying concept is this one. All right, and for fanatic accountants out there, do see my other videos on what's a balance sheet and what's a profit and loss account, so on. But basically what Lehman Brothers spotted was a flaw in the accounting rules. What it did was it worked out, so let's put Lehman Brothers over here. It worked out that on a standard repo, now remember, that's in theory borrowing cash, posting securities as collateral. On a standard repo, if you like, the haircut was relatively small. So on a standard repo, Lehman Brothers might post securities worth £102 in return for £100 of cash. Obviously, making up the numbers, more likely to be US dollars. That's what I mean by a haircut. You're posting a bit more than you need to, because obviously securities can move in value, whereas cash doesn't. All right. Now, what Lehman Brothers spotted was this. Okay, if you posted, let's say, £105 of collateral as security for a £100 loan, you didn't need to treat the whole thing as a loan in your accounts. Okay. Now, I'm not going to go too technical on you here, but basically, Lehman Brothers worked out the accounting rules, said if you post enough collateral, increase the haircut as it's known, in one of these agreements, you can actually treat the whole thing as a sale. All right, you don't say, well, I'm basically using, okay, my securities as collateral for a loan, so I better recognize a liability over here, because at some point I'm going to have to repay the cash. You actually treat it as a sale. So I'm offloading securities, all right, and therefore any cash that comes in, I can use to pay down debts, for example. I don't have to worry about the fact that actually in reality, I'm going to have to reverse this transaction. Now, the actual commercial reality is they were going to have to buy back those securities, okay? But thanks to a quirk in the accounting rules, if you up the amount of collateral, increase the size of the haircut, okay, and the 105 came from the idea that £105 of collateral to support a £100 loan or more, there was also a Repo 108, no prizes for guessing how that got its name, you could actually get away with not recognising the obligation to reverse the whole thing later. If you're wondering, how much difference did that make? It's estimated that by doing that, and don't worry if you didn't get the full details, by doing that, Lehman Brothers removed $50 billion of debt from their balance sheet like that. Okay, didn't really, but that's how it looked. Right, it flattered the accounts. Now, other issues. MF Global. Okay, how did MF Global tries to take advantage of the repo market and then come unstuck? Okay, you may have heard the case. The firm, famous trading name in the market, suddenly disappeared, went belly up not so long ago. Okay, what they were doing was they were basically buying bonds, okay, and then repoing them on, which means using them as security to borrow, all right. And what they were doing was banking the difference between the interest they receive on the bond, okay, and the interest basically that they were paying under a repo agreement. So they were, if you like, arbitraging the difference between the amount of interest on the bond, okay, and the cost of a repo involving that bond. And that worked fine until the underlying bond issuers which were sovereign, started to struggle. In other words, as the value of the bonds started to drop, suddenly MF Global realised it was horribly exposed. Okay, counterparties started to panic, and they started to call in all of these kind of repo agreements. So suddenly MF Global found itself in a cash squeeze triggered by the repo market. All right? So a fairly innocent sounding part of the market can cause problems and has done in the past. All right? And I'll leave you with this thought. At the moment, there's a lot of repoing going on between central banks in the various European countries and the ECB. All right? And what's happening is those banks, commercial banks within the eurozone, are struggling for capital. So what's happening is they are posting collateral with their central banks, so commercial banks posting collateral with the central banks in return for cash. All right, that's triggering loans from the ECB to those central banks. Okay, and there are some questions being asked about the quality of that collateral. All right, I mean, it's all very well saying, well, a repo involves high quality securities in return for cash. But what happens when you run out of high quality securities? What happens when all the high quality securities have been already used as collateral for loans? Well, the answer is you start to get central banks and the ECB accepting much lower quality collateral. Okay, and where do you draw the line? All right, once you start accepting rubbish in return for loans, okay, there's got to come a point where whoever is the other end of those loans, whoever's accepting the collateral, is taking on more and more and more risk. Okay, and that is something that's contributing to the kind of feeling of nervousness around the eurozone right now. And one final thought is this. How about this as an idea? Now, it's called rehypothecation, at which point you may have stopped the video, but hang on in there. Rehypothecation is this idea, and it adds to this feeling of instability in the eurozone. What if, okay, having agreed a basic repo, so, having set up this basic repo agreement, what if the person who takes this collateral is able to re-repo it, lend it out to somebody else, before the first repo agreement terminates, all right, and apply a separate haircut to it and so on? Then you've got the same lump of collateral being used as security for multiple loans. Where do you draw the line? And there's no clear answer to that question. Who in the market, which regulator knows how much rehypothecation is going on? In other words, for every sort of $100 of supposedly decent bonds out there, how many loans are being created? I'm not sure anyone can give me a single sensible answer to that question. So, the word repo, short, in principle, the concept is very simple, but bear in mind that the simplest things can often cause the most damage, and the repo market, given the size it is, okay, certainly has potential to further undermine Europe.